Leave, but we'll connect back to his network. I'm not hearing anything now.
Yeah, good morning, everyone. I hope you can hear me clearly.
Good morning, sir. Yes, sir.
Yes, sir. Good morning,
sir.
Good morning, sir.
Yeah, good morning and welcome.
Good morning, sir. We can hear you clearly, sir.
Yes.
Good morning, everybody.
Yes. So thank you for joining today's session. As we are all aware, every month, the department mounts the monthly seminar series, basically for the postgraduate students. And the essence of this monthly seminar series is actually to bring the town and gown together. We bring experts from the industry to share their experience with us, especially in the area of risk management, insurance, or pensions. So today we have a very important personality before us, and Dr. Misike, who is the coordinator, will be introducing him. So he will be presenting the seminar for this month. From his profile, you can see that you guys are very lucky, for him to have agreed to present before us. I must also say that if you are aware of any personality that you want us to bring for the seminar series, you can always reach out to me or reach out to the coordinator. All the speakers that we will be bringing have always been referral through students like you or our alumnus that are very, very passionate about the program. So please feel free to make recommendation, and we will always do the needful. So we're very happy to have you around, and I hope that you would gain maximally from this. I want to hand over to Dr. Misike from this point onward, the seminar. Dr. Misike, over to you, sir.
Okay, thank you, my HOD. Good morning, everybody.
Good morning,
Good morning,
sir.
sir. Good morning.
Good morning, sir. Once again, you are welcome to today's seminar series. It is my great pleasure to introduce our speaker today, Mr. Olutoye Ambekemo, a highly accomplished banking and risk management executive with over 2 decades of progressive experience in enterprise risk management, asset and liability management, as well as operational transformation and governance in leading African financial institutions. Mr. Ambekemo currently serves as the Chief Risk Officer of Sterling Bank Limited, where he plays a pivotal role in shaping the bank's risk culture and providing strategic guidance to both the board of directors and executive management. Mr. Olutoye has a proven track record of designing, implementing, and overseeing strong risk framework that align risk appetite with strategic growth, capital adequacy, as well as regulatory expectation. Mr. Olutoye holds an MBA from Edinburgh Business School and is an alumnus of the CRO program and senior masterclass in the United Kingdom. He is a fellow chartered accountant and banker, as well as a fellow chartered risk manager. Also, Mr. Olutoye is a GAP-certified professional in banking risk and regulation. Ladies and gentlemen, please join me today as I welcome our speaker, Mr. Olutoye Ambekemo. Mr. Olutoye, you have the floor now.
Thank you very much for those kind words. I'm truly humbled. And I also thank you for the opportunity to be able to discuss with the team. So thank you very much. I hope it's okay to also say great Akokite. Hope you can hear me very well.
Yes, we can. I can
Great.
hear you.
Great.
Yes, I can.
Great.
Well, the last time I asked. Prof, thank you very much, Prof. So you can also see my screen.
Yes, you're welcome, sir.
Can you also see my screen?
Yes, we can.
Okay.
Yes, we can see your screen.
We can see your screen, sir.
Thank you.
You're
So,
welcome.
thank you. My name again is Olutoye Ambekemo, Chief Risk Officer for Sterling Bank Limited. So today, what are we going to discuss? We'll just look at from concepts. I think I joined briefly last week when Edward was presenting. He went deep into the market risk. But we'll look at concepts to realities of the operating environment. So from a CRO perspective, from a strategic perspective, what are we looking at? What should we be looking at? And what is the realities of our times currently? We'll look at what the real world Nigerian banking perspective is. I will try and look at roughly 7 modules. I know it's about an hour that we have. We'll try and just touch base some strategic issues. We'll look at how the Nigerian banking landscape is currently categorized. We'll talk briefly about risk management fundamentals. credit risk and lending, market and liquidity risk, operation and compliance risk. What are the margin risks we are seeing at a CRO level? And the CRO of tomorrow, what really should we be looking at? When you look at the Nigerian banking landscape currently, we have 33 licensed commercial banks. The Nigerian banking industry is the second largest in sub-Saharan Africa, behind South Africa. The banks have now been categorized based on their capital. As you are aware, CBN introduced a new capitalization for all banks. So essentially, you have three categories. You have the regional banks. Their minimum capital base is 50 billion. You have the national bank. Their minimum capital base is 200 billion. And you have the international banks. Their capital base is minimum of 500 billion. Based on the CBN guidelines, all the banks must meet these requirements, minimum requirements, by the end of this March. So roughly we have 2-3 days to go. My bank has met it though, just for information. And according to what the governor said, Mr. Cardoso, out of the 33 licensed commercial banks, he confirmed last week that 31 banks have actually met these requirements. So the banks are very strong. I'm almost certain the other 2 banks will meet the requirement, or will just try and maybe merge together. So this is the landscape of what we currently have. Another thing to mention here is you also have what they call holding companies. There are some banks that are part of holding companies. What does that mean? That means they are a subsidiary. The bank themselves are a subsidiary of what we call an holdco. That means the holdco has other subsidiaries. So the bank is not a standalone. And we have 7 holding companies. I'll use Sterling Bank as an example. Sterling Bank is an holding company. So you have what we call Sterling Holdco. Same thing, Access Holdco, First Bank Holdco. There are 7 of them: FCMB, Stanbic, IBTC, and FSDH. So Sterling Holdco now has 3 subsidiaries. So you have Sterling Bank. You have the Alternative Bank, which is an Islamic bank. And you have what we call Sterling FI, which is an asset management bank. So sometimes when I don't know if you check Nigerian Stock Exchange, you won't see Sterling Bank, for example. You won't see First Bank. So you will see something like FBN Holdco, Sterling Holdco, Access Holding Company, GT Holdco, and that is the categorization. 7 banks are holding companies: Sterling, First Bank, FCMB, GTB, Access, Stanbic, and FSDH. I can proceed over and clear. Are you staying with me here?
Yes, very well.
Thank
Very
you,
well, sir.
thank you. Then sometimes when you read materials, you see that they categorize banks by tiering. So that's just the size of the bank. So you have banks they classify as tier 1, tier 2, tier 3. Sterling, for example, is a tier 2 bank, simply because of the size. For the tier 1 bank, you will see, for you to remember the tier 1, They call them Fugaz. F-U-G-A-Z. F-U-G-A-Z. F First Bank, U UBA, G GTB, A Access Bank, and Z Zenith Bank. Fugaz. F-U-G-A-Z. So what is the CRO? What are we looking at today? What are the concerns that we are looking at today? Hello? Godson, is it you? You might need to mute.
I've muted him.
Yeah, I thought Godson be wondering how was I able to see him here. So what are we looking at? We've all heard what is going on in the world. You'll be hearing trains that you'll be saying Strait of Hormuz, Strait of Hormuz. And everybody is wondering what's going on here. So if you look at, you know what we are discussing here, from concept to real life, you know, after all the grammar, the concept, what is the real life? Which is why I'm giving you a high level perspective, how these things all flows into decision making. So if you look at what current event is, you know, the man on the street is asking himself the question, oil price is going up. What does that mean? Transportation cost has gone up. What does that mean? His disposable income has reduced. When you step it up, what does that mean? From a macro perspective, inflation rate might start going up. Recall that inflation rates are over 30%, but it's now down to 15%. With this increase in oil price, transport, and all of that, what does that mean? It's going to increase the inflation rate, and we'll start seeing it from March numbers because the war started, I think, first week in March, 3rd or 4th. So there are now policy issues for a risk manager. What is the implication? Policy issues. One, the question now is, which of my portfolio, which sectors will be affected by what is going on, directly or indirectly? The Strait of Hormuz is so essential because 20% of global oil passes that route. 20% of global liquefied natural gas goes through that route. Gas prices in US is almost 100% to the pre-war levels. So anything that happens there affects the global economy. So a risk manager, a decision making, is now looking at what? The reality vis-a-vis the concept to take decisions. One, supply chain is going to be affected. So imagine a company that is importing something from UAE or importing something from Bahrain, not even Iran, just importing. By the closure of that route alone, there's a supply chain issue. He's expecting his goods by April 3rd. Of course, the route is closed. Cash flow is affected. His interest rate on his loan is going up. Potential for default has increased. That is the reality of ground. So CRO will now analyze and say, look, what are the sectors that will be affected? Directly, the manufacturing sector. Why? Diesel price has gone up 30%. FX is tightening. At some point, reserve was over 50. Now it's down sub 50 because some external people are withdrawing their money in what we call flight to safety. You know, you are an investor sitting in Switzerland and you have an experience and you're just wondering, look, let me just have my exposure. I don't know what's going on. People tend to go into gold and the dollar, you know, do for a safe period. Manufacturing, because their cost will go up. Earlier this week, Dangote was talking about I need to start working from home. What is he really saying? He's saying businesses need to start managing their cost. So cost will go up. So if someone is coming now to take a loan from me and it's manufacturing, I have to build in the scenarios of what will happen. I have to know that potentially it might be affected supply chain. Potentially, you might not be able to access FX or have access FX at a higher rate. His cost will have gone up. His cash flows will have reduced. The question is, can he still meet my obligations? So I now need to build all this. I'm sure at some point you'll have talked about stress and scenario analysis. So if I'm doing a cash flow, if I'm stressing this company's cash flow, my scenarios have to be more tighter than maybe if it was in December. I have to now assume, for example, instead of doing 1.5, maybe I assume a 1.550, a 1.6 for FX. Maybe his cost before was 100 naira. I have to assume that cost might go up to 150. So I have to build all this in assessing. Manufacturing will be affected. Oil and gas, from a portfolio perspective, we just call all of them oil and gas. But there are different segments. Largely, oil and gas sector is into three. You have the upstream, downstream, and services. The upstream are the ones that are producing. So I'm sure you've heard of First E&P. If you check you heard of Seplat, Dangote. These are the ones producing the crude itself. So these guys are in what? They are in money. Because you are talking almost between 70 to 75% increase of what they can sell, their selling price. Before they were selling crude at maybe 65. Now they are selling at 105, you know, when you take the average, or 100. So you can see the money they are making. So those guys are what? Doing okay, very okay. Services, fair, because services, they are just offering their services to the upstream largely. Maybe the people that supply the drilling machine they will use, transportation and other things. But the downstream sector will be affected. Because these are the ones that largely import. When you are hearing, when they say there is fight between Dangote and some people, these are just the players in the downstream sector. You know, we are not talking concept to reality. Because these guys are the ones selling, they are the ones owning the petrol station, selling to the last mile. They will be affected. One, those ones that are importing, prices have gone up. Will they be able to sell and compete with Dangote? Two, even if they buy from Dangote, who has also increased his price, you will see that the transport cost, taking it from here to maybe up north, will also have to build it. So they also will be affected because their margins compress. Can they still meet their obligation? Do I want to still, at this time, extend credit to players in the downstream? Those are some of the key questions that the realities of our time will make you to ask the question. And some people, crude, you buy it at going market price. So in reality, people who argue why is Dangote increase price, but in other reality, is also importing crude, and there is no way. And if you are dispassionate, prices have gone up globally. Everybody is complaining. Which sector will be affected? Those in the transport sector. Jet fuel is up potentially about 100%. Transportation, either way, we all use transport. We know how much we buy. Whether you buy fuel, you know how much you buy fuel now. From now and thereabout, we are talking 1314. Transport, you know how long you used when you use bus or Uber or anything. You know what you pay for it now. If you are talking about 50% increase, 40% increase, so their margins will reduce. You know, sometimes we always say you want to pass it on, you want to pass it to the, you know, they will say the transport guy will pass it to the people that will join the board. The issue is that the demand will drop. So when you increase your price, potentially the demand will drop. If you check now, if you have to go to work, you have to go to work. But you see that some businesses are encouraging working from home. So all those who are working from home now won't be taking the transport. In my own place, they've encouraged people to start working from home as much as possible. So ordinarily, instead of you to have gone to the office 5 times a week through public transport, you are now going maybe 2. And you cannot count that in thousands of people. So their margins will reduce and they will have pressure. Those that will be affected, agri will also be affected to a large extent because of supply chain. Even though this might not be too much impact because Dangote is also producing fertilizer. So that has, and there are other companies in the Rama which will moderate it. But the greatest impact might be you and I, which is the retail and consumer, if you look at the last one there. So the consumer or the retail guys are seriously under pressure because the disposable income has reduced. By the time you collect your salary, you knock off how much you pay for this, how much transport has gone up, food inflation too has just gone up, it's going up now, back up now. So you see that what is left is reduced. Well, can you pay my loan? Do I want to give loan to this set of people? If I have to give loans to this set of people, do I want to tighten my rack? So the people will say, I can't give this set of people, maybe you give those that are earning minimum amount of this, because those ones can still be able to absorb. But the reality is the consumer, the retail will be affected, which is why the man on the street, me and you, we are shouting and saying things are tough. But those are the realities of the times. So a risk manager, after all the concept and everything, you are acting yourself on a high level. You are monitoring, which is really the real work, strategic monitoring. Because those monitoring are what will dovetail into decision making and ultimately what the team will have to now implement. So you are tracking so many things. For example, ending of last year, all of us were talking about interest rates will go down this year. And Cardoso's first meeting, MPC meeting, they reduced interest rates. Everybody was fine. That was the scenario. But the scenario has changed. Because now inflation is going to go back up. And what that means is that they might start increasing interest rates again. Can you imagine with all this pressure? Banks, I'm talking to myself, we also start thinking of increasing interest rates. But those are the realities of the times. So you need to be running those strategies on the strategic level. So our assumption now, for instance, is that we might be talking about an inflation rate of 18-19%, potentially, if not this month, maybe by April, May. What that means is that you might be factoring additional 50, 100 basis points. 100 basis points means 1%. 50 basis points means 0.5%. Increase in interest rate. Because you use interest rates, 1, to fight inflation, and 2, to encourage the foreign guys to bring in their dollar or keep their dollar so that you moderate interest rate. So that's the link. So anytime you are seeing inflation go up, you are almost certain interest rate will inch up to also keep the FX. So the scenarios have changed. The analysis have changed. You are not talking about sectors that will be affected, sectors I don't intend to lend to, or sectors I need to tighten the rack. Rack means risk acceptance criteria. The criteria I want to tighten it, make it more tougher. So instead of 50 people qualifying, maybe it's only 10 that will qualify for my loan. I need to build in the scenarios on my interest rate. I'm sure you'll have done a deep dive of, that's why I said we're not looking at the analysis of interest rates. Because there is an inverse relationship between interest rates, between prices and yield being the interest rate portion for interest rate risk. And that has implication on your balance sheet, not only credit. Because that has potential for mark-to-market gain, mark-to-market loss on your portfolio. Sorry. That has impact on mark-to-market gain, mark-to-market loss. It could wipe out your balance sheet. I'm sure maybe you've done it, or later you talk about concept about EV, economic value of equity. You can wipe out your balance sheet. Interest rate can wipe it out. Mark-to-market can wipe it out. And I used to give people the example of what happened in the stock market. You know, if you can buy a stock at 100, and if the company goes down, the stock can go down to, I think the minimum in Nigeria is 50 kobo, can go down. It has wiped you out. People have lost money. So these concepts are real, but it comes from the strategic level in positioning. And that's why I said there's a reversal. So now, automatically, you are changing some of your strategies. You are now thinking of potentially you can increase your loan. Because depositors will also have for increase in interest rate from your depositors. You're already thinking that, can I lock in deposit for longer period? So if I want to take deposit, 30 days deposit, I'm saying interest rate might rise. Let me start taking 90 days, 180 days, 1 year deposit. So I lock in. So when interest rates go up, I can still reprice my loan, but I've locked in my deposit. I keep my margin or increase my margin. That is the reality of strategy. Are we on track? Are you with me, team? You know, we are a team now.
Yeah.
Yes, sir.
Yeah.
We're enjoying you, sir.
Yes, sir. We are with you, sir.
Yes.
Okay. I said, let me just hear your voices, so that so I know we are together. So is the strategy. So when you see the people are saying the concept, yes. But you know, you need to know that the macros drive everything. So while a lot of people are talking social media, this, that, you need a strategic, you need to know the issues and dimension. It's not an emotional thing. The reality is the reality. So while people are complaining that, you know, the inflation goes up, potential interest rate might go up, no matter how people want to do it. Because those are the tools you use to manage them. This thing is okay. So I'm sure you've talked about risk. Let's continue. We've talked about risk before. I'm sure this is basic. Probability that actual outcomes differ from expected outcome. You expect something, but the actual outcome is different. You can see what I look at in both directions. So in a high level strategic thinking, you know, okay, let me put it this way. When people hear risk, you know, everything is negative. The risk, you know, so you always think negative. Yes, but in reality, a strategic person knows that for every risk, there's an opportunity. And that's why you also say the higher the risk, the higher the return. So the risk is not the issue, because in everything, there will always be risk. This morning, I had an issue joining. My plan was to join 10 minutes before, and I just joined like almost on the spot because something happened, operational risk. If you are going somewhere, there is a risk. If you are in the public transport, who knows what the driver is on? Or even though he's not on anything, who knows the issues the driver has had at home that is so angry drive. So there is risk. So the real issue is not the risk, because they say in banking, you are in the business of taking risk. You take people's money. In elementary banking, they will say bankers are just what? Financial intermediaries. That's just the basic thing. Take from the depositors, give to people that wants the money. Charge this one interest rate, give these people their return, make your spread. That's it. So you are in the business of risk. The risk, even at that elementary level, the risk there is the person you're giving money to, the person might not repay you back. This other depositors is what? Is asking for his money. That means you need to manage that. So the risk is not the issue. So anytime, if you see all those, I don't want to Buffett or every other person, They always go to that when people are in risk, when there is risk, people tend to lose their composure, you know, because they apply emotion. Hey, you know, but if you are at a strategic level or you are thinking strategically, you are thinking what are the opportunities. Just let me give you an example. I've just told you now, when you hear oil price going up straight off Hormuz, you know, we've just talked negative. But I don't know that you read between the lines. I've just told you that there is a sector, upstream sector, that their profit is like 50% minimum. So there's always an opportunity. So I could say, let me focus on these guys and maximize them. I won't give these guys. So you're always in the process of managing risk. So risk is in either direction. And you always have to know that when there is risk, there is what? Opportunity. So you are dispassionate. What is the risk? Okay. What are the opportunities? And when you now have the risk, the question is 5 key questions outlined on this slide. Can you identify the risk? They have tools for it. I'm sure under operational, you'll have talking about RCSA, scenario and risk registers, portfolio management, scenario analysis, stress test, market risk, all the works. If you identify it, can you measure it? This really is the most critical part. Can you measure the risk? What that means is, if I'm going to part with 100 naira, okay, you know, you cannot talk grammar, the risk, credit risk, this, that, okay, all right, no problem. Can you quantify the risk? Which means out of this 100 naira, how much can I lose? Then the question is, yes, I can absorb it. I want to take the risk. Because someone will say, out of this 100 naira, you can lose 30 naira. You now ask the question, what can I gain? If it plays in my place, you can say you can gain up to 170 naira, which means you are gaining 70 naira. So the question now is, can I manage this risk, 30 naira from happening? Can I prevent it so that I go for the 170? So you need to measure the risk. And I'm sure you've heard the value, you know, some concepts, you know, value at risk is maybe quite popular when you're talking about your portfolio. Value at risk is quite popular. So when you measure, you now need to monitor. So you need a team that will be monitoring for you. So in most banks, you will have a portfolio management team. So they will have dashboards and all that. So for each of the team, credit risk, market risk, operational risk, all of them, they have limits. So you now look at limits, various limits. Portfolio guys now look at early warning signals. You also have a team they call loan monitoring and all that, and early warning. So they monitor your loan, and loan starts shaking, they quickly escalate. So you have various teams that are monitoring. Can you control it? But you know you can monitor and not be able to control it. So can you control it? If this risk occurs, can I control it? If I have a car and I have a serious accident with my car, can I control it? Yes, if you have comprehensive insurance. Because they will replace your car for you. If I want to take an FX position, can I control it? Yes, you hedge. Of course, you pay a cost for the hedge, but you know the cost, and you now think what the potential upside will be. And of course, you now talk about reporting. So control can be management, or people will include, you need to manage the risk, and also you can fit into any of these ones. And of course, you need to report the risk so that it's clear. I'm sure we'll touch on reporting briefly at some point. So, you know, we talk about monitoring and all that. We now talk about, so now move to governance. So I don't know that you must have heard this one, they call 3 lines of defense. There are 3 lines of defense. And that is global. You have a first line of there, which is the business. The business are, most times everybody talks risk manager, risk manager, risk manager. Yes, but risk manager is not the owner of the risk. The owner of the risk is the person that creates the risk. So the person that creates the risk is the person that went outside to bring in the risk. So you have relationship manager, branch manager, all those ones they are talking to. So they are the ones that went there, marketing people and all that. Come, this bank. So they are the ones bringing the risk. So they are the owners of the risk. They call them the first line of defense. So they also have to identify all those things we've talked about. They have to do it themselves. Of course, the skill set of second line will come to it is more deeper, but they must identify, they must know when a customer is having problem. Hey, this customer, I used to see a lot of customers in the shop. Customers have been reducing, and this customer doesn't pay enough money. So early warning signal, even so the business people already knows that there's an issue. This customer is not like before. So they can't just create the risk and just dump it on the bank and move on. No. We are now talking governance in a well-established institution. They are the owners of the risk. The business unit or anybody that went outside to bring the risk. You now have the second line of defense. Two things, risk management and compliance. They are the ones that now set the rules. So they are the ones that will quantify the risk for you. They have models, they have all that. They are expected to be what? Subject matter expert. So these guys create the risk. They will watch out some things to be sure that everything is okay. But these ones are the ones that will look at it from a strategic level, quantify. They're also the ones that will report it. And in best practice institution, because they want them to be independent, second line of defense is independent from the management of the bank. Because you want to see the true picture. If you want to see the true picture, they just have to be independent. So, for example, me now, as the chief risk officer, I report to the board risk management committee. Same thing as the CCO. When you see CCO, then maybe when I'm trending, I'll do it in full. That's the chief compliance officer. So even though I have a dotted line to my executive director, I report directly to the board risk management committee to guarantee that independence. If everything was management, the way this thing is, things can be managed. Let's put it that way. You get internally. But you need someone independent to tell you the true things. Tell me what it is. The person has to be independent to be able to tell you the truth, which is why the structure is to the board. Then you have what we call the third line of defense, which is the internal audit. They also are independent. They report to the board audit committee or audit committee of the board. They test what second line is doing. So it's another layer. So the risk and compliance will be telling the board risk the way things are. The internal audit will tell the board audit team whether this risk and compliance team are doing as they are. So as they put it there, they're actually doing their job, not just saying they are. 3 lines of defense. And if you notice what it says here, it's not easy on the chief risk officer because everybody, you might have so many interests of so many people, which is why it's also important that the CRO must protect its independence. So talking about independence also, we have what we call Basel. We are running Basel 3 now. Yeah, it's always improving, it's always increasing. So you have 3 levels when you're not talking capital. I said earlier about CBN saying, look, banks must increase capital. People are always wondering, yeah, why? In the day-to-day, it's expected that your profit can absorb losses. But there are always unexpected losses, which is where capital will come in. And I'm sure if you have not done it, you might have a session. We can also look for someone to come and take a session on how you compute the capital. So under Basel III, there are 3 pillars. Pillar 1, you must maintain minimum capital. Minimum. For Nigeria, when you compute, there's a computation. You use your risk-weighted asset, so there's a deep computation on that. In Nigeria, there are 2 categories of capital adequacy ratio. Minimum, that's CAR, capital adequacy ratio. You have the DSIBs. Like I said, I'll write a lot of this, I promise in full. Domestic SIB, systemically important banks. FUGAs. So they keep 15% minimum capital adequacy ratio. Other banks, regional, any other one, keeps 10% of CAR. There's a template, there's a model, there's an Excel. It's quite basic. So you need to keep that minimum capital. And in most cases, you keep capital for the standard risk, credit market operational. Credit market operational. For each of them, they have various ways of compute. As I said, it's a full session on itself if you really want to delve into it. So you have various methods of computing capital for each one. You now have pillar 2. What pillar 2 is saying is that, look, you've done pillar 1, minimum capital adequacy. That's fine. However, you need to review yourself. Of course, regulator also comes and review. But you need to review yourself and review whether there are other risks you are carrying. And in reality, there are always risks you are carrying. So under pillar 2, you now have a lot of other risks that you need to measure. So you're talking about, you measure your liquidity risk, you measure your concentration risk to be able to do HHI. So there are other risks you now need to measure to now compute your capital. So that, as the place put it there, banks must assess their own capital needs honestly. So you will do your own analysis, assess it, and now make sure that you keep minimum. So minimum should be more than 10. For example, let me give you that. For us, even though we are 10%, our board approved minimum CAR is 12.5%, even though we are well over 15 at this time after the capital raise. So you now keep a higher capital. You need to keep a higher capital because you have other risks you are carrying apart from the 3 main ones: credit market operation. You have liquidity, you have concentration, regulatory risk, strategic risk. You can name it. Legal risk. So all those ones come into pillar 2. So you assess yourself and now present a document called the Internal Capital Adequacy Assessment Process Report, ICAP. All banks must submit their ICAP by April ending of the next year. So we need to submit by April ending for audited financials of December. Then the third one now is market discipline. Market discipline means you must disclose all your risk, your exposures to the public so that it puts you under pressure. Because if you have so many risks, investors will look at it and say, this bank, the risk is too high, let me not put money. Depositors will look at it. I know we are individuals, how much do we have? But a lot of the big boys, they look at these things, and it's in the financial statement of all banks. I know when the bank release result, what we just check, our profits, you get all the profit. People enter the bank, want bonus, look at profit. People outside, shareholder, looking for till it's profit. But when you go down, you will see notes, you will see a lot of things. You might see up to 10, 12 pages on risk management disclosure. The penalties that you are fined during the year, you put it there. So many things, the fraud that occurred, the cyber issues you had, you put everything there. So it puts banks on their toes because you know that your main investor, people are looking at it and might say, this bank is too risky. There's a gap here. It might affect their share price and others. So those ones are also factored in. Governance, capital adequacy. Just checking, okay. So credit risk and lending. Of course, credit is still the highest risk. About 60 to 80% of most banks' risk portfolio is actually credit, which is loan, essentially. And you've seen that the non-performing loans have gone up for banks. Before, it used to, the CBN limit is 5%. It has gone up this last year based on CBN's report for December. And that's because there is no more forbearance. What CBN did before was, you might be hearing, is a CBN forbearance. So there are some loans that CBN, the loans are not really performing. But because a lot of the banks cannot have enough capital to absorb it, or the profit has not really increased, CBN says, I will give you forbearance. So instead of you making, for example, 50% or 100% provision, you might just, okay, just make 20% provision. But CBN has removed that forbearance now with the fact that the banks have enough capital. That's why part of where they show off their capital base. The banks are making significant profit year on year to absorb some of these things. So initially, the NPL ratio will go up because no forbearance, you now have to classify everything as non-performing. When there was forbearance, you won't classify it as non-performing. So that's the reason why the NPL ratio has spiked. But that will reverse sometime this year as the banks continue to write off these bad loans. I think around 50% of Nigeria economy is informal, the SMEs and all that. So that's it. So there are challenges specific to credit in the Nigerian banking industry. One is concentration risk. A lot of banks are concentrated in oil and gas, and agric, and general commerce. So there's concentration risk. The problem with concentration risk is that, you might make a lot of money, but once there is an issue with that industry, you will almost always have credit issues. So that's why you see that most times when there is a serious issue in the oil industry, it affects the banks a lot. A lot of the exposures are actually in the oil and gas industry for all banks. And that's the truth. So it's something that banks are now trying to make sure that they diversify their sector. What that means now is that you continue to grow your loans, and as you grow your loans, you focus on other sectors. So, it's a competition. So by focusing on other sectors, the denominator will increase, which will now reduce the level of concentration. The other issue is you might have FX-induced credit risk. They say something here that a business could be performing. What caused, why do a lot of people not like maybe this government? It was because of that initial posture. Remove subsidy, devalue the currency. The problem is, even if you are doing well, if you have a USD obligation, you are in serious trouble. Serious trouble. Because before, when you have when dollar was 500, for instance, if you have an obligation, maybe 100 obligation, all you just need is about 50,000 naira, and you'll be able to meet that your obligation. Now, because the rate is at 1.5, you need what? You need 150,000 naira to meet that obligation. So it's a major issue. So when there is a devaluation, businesses that are even doing well, we have serious problems. And if you check when that devaluation occurred, if you check financial of banks for 2023 and 2024, you see a lot of people made losses that are terrible losses at that time. The Dangote made losses. MTN just recovered this last year. They made serious losses. All the manufacturing guys made losses. Flour mills and MTN was even pathetic that it almost wiped out their capital base, even though now they've stabilized because the exchange rate has stabilized. But what we are saying is when there's a significant deval, it can crystallize into major credit risk. And that was one of the reasons also why CBN gave that forbearance, to try and moderate the impact. There also are collateral limitations that we face as banks. Sometimes we have land, we have collateral that they've given us. To realize the collateral might be an issue. Sometimes they will say you can't sell some things in a particular place. They will say this one is political, this one is this one is. So there are issues we face sometimes in realizing collateral. Someone will tell you that if an Oba gives you a land as collateral, are you the one that wants to go and sell the Oba's land to realize your loan? You know, you have issues. So there are softer issues. Even when you go to court to say, okay, someone has defaulted, you want to realize the collateral, the customer can take it to court. You can be in court for 5-6 years. We can see sometimes they will tell you that they are deciding a case after 20 years. You get, whereby everybody has retired. Maybe after 20 years from now, Prof will have retired, me too, I will have retired. People will have retired, but the case is still there. So there are collateral limitations. And then financials of Nigerians, you know, sometimes can be unreliable. When you look at it very well, you just see that the numbers are not jiving. Yeah. So, you know, sometimes some people can be funny, you know, put things together just to get the loan and all that. But when you do the analysis and you run your numbers, you see that it doesn't really reflect the true state of the business. So credit risk remains the biggest. I don't know that you touched on this one, just that there is no more IAS 39, which is though you make a provision, they'll do your analysis, there's an NPL, you make your provision. So it's really after the fact that the loan has become NPL. But I guess we've moved to IFRS 9 now, from 2018, 2019, thereabout. So you make your provision from day one. So you only have 3 stages: stage 1 performing, stage 2 watch list, stage 3 non-performing loan. So performing, you still try and make some provision, general provisions. I think now it's 2%. Watch list, the loan is not non-performing, but you're already showing signs. So you also have to try and make a provision on that, much higher. So if you are still looking at CBNs, we'll be talking doubtful and all that. But IFRS is slightly different. But just to give you an indication, you need to make more provision. But for NPL, of course, we're talking about 100% for non-performing. I think the key point here, so we're not going to the details, is that we're no longer using IAS 39, which is provision after the fact, after it's an NPL. But now you set aside provision more or less based on future expected losses. So I'm sure if not, we'll continue to schedule something for, you talk about loss given. So there's a computation how you go about it, what the exposure default would be, what your loss given default would be, what the probability of default. So you do all that from day one and make your provision. So you do it by sector and all that based on historical events you've seen. So you assume that there will be losses. So if you are giving loan to maybe 10, maybe individuals, retail loan, consumer loan, individual loans, you know that it's not likely that you realize the 10. Even if the people really wants to pay, along the way, they might lose their job. Life happens. So, you make provision. You won't wait till maybe 3 of them default. You will assume that 3 will default. There's a model you compute, and you make your provision from day one. Unlike IAS 9 that you wait till the default. Are you with me, my team?
Yes, we are with you, sir.
Yes, sir. We are with you, sir.
We are with you.
Yes, so
We are with you.
All right, okay. I just wanted to be sure because I know Arsenal fans here. Arsenal fans are jittery.
We are with you, sir.
I just want to know that are the Arsenal fans still with me too?
They are winning. They are winning.
Arsenal fans are not GT. They are the champion.
Yes, sir. We are with you. We are with
We
you.
are with you. We are with you.
Your voice is shaking, Arsenal fans.
The coordinator is with you as well.
That's still the best team in England.
The coordinator is with you.
Okay, all right.
Best team for not winning trophies.
Best team this year.
All right. So, you can see now the way we are talking about Arsenal. Why are we talking about Arsenal? We've run some models, Abby. We've gone back historical. We've run the model and we said the probability that they might not win it this year is what? Is high.
Is high, very high.
You can see they might still win it, based on the model, and the model is not lying. Abby. Every year. Yeah.
Every year.
So the probability is high. And that's why they themselves, they are shaking.
Sir, the model we like this
We are
year.
different. This model is not true.
The model don't lie this year. We go carry out.
They are perpetual bottlers. They'll bottle it again.
I'm sure you know the model you are talking about is not real now.
The model has been tested and trusted, though. We've stress tested it. We've done all scenarios.
The model
base
now.
Model, moderate, severe.
They can change formula.
The Akata model has changed.
If they change formula, they will make it.
Thank you. So let's try and start winding down. So what does the bank do? This one is just like you said, we're just talking what we look at, at our level, and what we talked about car. We've talked about NPL. There's also something, 3 key ratios that CBN is very particular about. We call it SOL, single obligor limit. You must not give me and connected people to me if I'm part of a group. You cannot give me more than 20% of your shareholders' funds. The last one says prevents catastrophic loss from a single large default. 20% of shareholders. You cannot give me and people. So it's not just me. You need to look at the group, my group, and add everything together to be sure that you do not exceed 20%. By law, you must not give more than 20% of your gross loan, 20% of your loan portfolio. You must not give more than 20% to any single sector. Agree, all those ones, you must not give. Like we said, it's just trying to what? Moderate the risk. Remember what we said before, you can use limits to control and manage your risk. But for government, very important, government is 10%. So all of that sector is 20%. But government must not be more than 10% of your loan portfolio. So government too is what? Is a sector. I know government borrows money a lot. So this also what? You try and moderate it. Even though that these limits are regulatory, you still need to get what? Your board approvals. There's something they call related party or insider credit. That's the popular term. What that means is people that are directors, you must not give them more than a particular amount. And that amount is 5% of paid up capital per director. I hope you are following me. SOL is on shareholders' funds because there are different computation. Concentration is on the loan. Insider credit or related party is based on what? Paid up capital. So you cannot give a director. If you for those that like to look at things, you can go and study what happened in First Bank. Why those issues, just study and all those ones. You are able to read up. You will see. So you cannot give more than 5% of your paid up capital to a director. And the insider credit is in two. They have 2 limits. One is 5%. You cannot give more than 5% of your share capital to me as a director. You cannot give more than 10% of share capital to all directors when you add it. So one director cannot be more than 5%. All directors together cannot be more than 10% of paid up capital. Market and liquidity risk. Okay, we've talked about this. Translation risk. I'm sure these will be quite basic for you. You subject matter experts on this team. Translation risk. You have your USD assets where you are translating to Naira. What it does? Because these are the risks you'll be monitoring. You'll be looking at strategic level. For example, let me give you guys an analysis or something, a take home. We read in the paper, Tinubu has borrowed money. If you check, when Buhari was there, this is the amount. When Tinubu this is the amount. But what if I tell you that is wrong? Will you believe? So you need to leave the noise and say, okay, because the base you are using is not the same. What that means is when you are converting, let me just say $1 billion at 400 during Tinubu, during Buhari, sorry. That means we are owing 4 billion. You get what I'm saying? $1 billion at 400. Because we are reporting in Naira in Nigeria, we are reporting in, the newspaper will report in Naira. So they will convert it. The DMO will report in Naira and convert it at the currency. So let's say Buhari borrowed $1 billion. The thing was 400. That means Buhari borrowed 400 billion Naira. That's how it will be reported. Let's say Tinubu now borrowed 2 billion. Let's say Tinubu borrowed the same 1 billion. Sorry. Tinubu borrowed the same 1 billion. But now it's at 1.5. So Tinubu has borrowed what? 1.5 what? Trillion. Are you with me here? I don't know whether you get that concept.
Yes, sir.
Okay.
Yes, sir.
Okay. So, but it's the same $1 billion. But when you translate, it comes to 400 million. This one comes to 1.5 trillion. So when you are reading, 1.5 trillion, how many years? 2 years. Hey, what to Jonah, what to learn. But we are talking about a risk manager, a strategic risk manager, who wants to what? Take decisions. Take decisions. So it's not an emotional thing. You have to really look at the numbers. That is a translation risk. A weaker Naira, that would say that inflates asset value. You have to be careful. FX-induced credit risk, I think we mentioned it before. Even a good business, if you have to pay in dollar, you know what you are going through. We that work with bank, at least, we won't say we are not being paid reasonably well. We won't say so. But imagine if you have your child abroad. I remember what happened then. Even our guys everybody will be shouting. You are still being paid well. But then you used to convert at 400 and send money to your child abroad. Now you have to convert and go and buy a 1.5. That's almost 200%. You need 200% more Naira. So even though you are doing reasonably well, you know when you touch your pocket that you are in what? Trouble. FX-induced credit risk. Transaction risk. When you do your transactions in foreign currencies, maybe USD loan, because in a bank's balance sheet, you need to do all these things. You have Euro bond, you have USD loans. I'm sure when you talk about market risk, you know the implication of the Euro bond when yields go up or down. So all these things are things that you need to look at from what? A strategic level. They will tell you that all other risks can be managed, monitored, and you can still survive. MTN almost wiped out their capital. They made losses close to 1 trillion. But they are back in business. Their profit now is closer to 1 trillion, declining heavy dividend. They are positive. Dangote is on a roll. Bua is on a roll. A lot of the big businesses are on a roll. But they've made losses. Just 2 years ago, they made losses. Under 1 year, they recovered. Because almost all the other risks you can recover. But once there is a liquidity risk, you are gone. They will tell you that a bank that is not liquid is gone. So that's why they said the greatest risk most times liquidity risk. They call it the silent killer. And you can think about it. If depositors today say had something about one bank and everybody say, let me go and collect my money, that bank is gone. From the fact that after day 1, day 2, people are still coming, you don't have enough money to give, they spread the rumor, to reputational risk, to people not giving you money again, you are just gone. So liquidity risk, we term it as the greatest risk of all, if you can't meet your obligation. And liquidity risk, even now, personally too, if you are owing someone and you can't pay the person, your reputation becomes at stake. Even you yourself, you know that, if you can't meet your obligation, you can't, liquidity is money. You can't buy food. You can't pay for your transport. You can't pay your children's school fees. you'll be depressed. It's almost as if you are gone. When people see people committing, of course, we don't know why they do that. But when you look at it, at the end of the day, what is it? Emotional. They can't meet up. Liquidity is the silent killer. Under Basel, I'm sure you should have come across, there's what they call liquidity ratio. Regulatory liquidity ratio. You need to keep liquid asset. Some of these things just to ensure that you have liquidity. So liquid asset, government bond, government securities, cash, so that in case depositors come and want their money, at least you have liquidity to survive. So CBN mandates that banks keep 30%. For DSIBs, domestic systemically important bank, they keep 35% liquidity ratio. There is two ratio introduced by Basel, adopted by the CBN too. We call it LCR NSFR, liquidity coverage ratio. You run a stress scenario and you must be able to make sure that you can meet your obligation in 30 days. Net stable funding ratio. You do your stress scenario, but you must make sure that you're able to cover your obligations in 1 year. And these are the tools that we do. We compute this regularly. And when there is an issue, then you have to now escalate. You take decisions at ALCO, and if you have to escalate to the board, you do that. Banks also have what they call a contingency funding plan. So you run all these things, and then you have a contingency plan. What happens if most contingency plan, they will tell you to bank specific. So what are the things that can, everybody is okay, but my bank has problems. So there are things that will affect the bank. There's a serious cyber crime against the bank. So every other people are okay, but your bank will go down. You have a serious reputational risk. There's a legal issue that has crystallized. So that's bank specific. So you do your scenarios, run your numbers. Then you have what you call the systemic. So, maybe the banking industry, what can affect the banking industry? So you run your models too. It can be a significant country risk downgrade and all that. So you now have a plan, a detailed plan. It's a document you do yearly and approved by your executive management. What this one happens, what do you do? You have a crisis team that you need to bring up, that you quickly bring up, a crisis team that meets every day. I've been involved in one of these in one of my old banks. You meet every day, you take decisions, you monitor cash flow, what kind of things do you say outside the posturing, what can you agree with CBN, are there assets you can sell? It's just, and all these things are practical, things that are normal that we also will do. You get, so you also can think, maybe people that need our work here, what if I lose my job? What is my plan? That's just what we are talking about in reality. What happens? Okay, what do I have? You get, okay, if this one happens, okay, this is this thing. Okay, I have one, maybe I have one land in Mowe. Okay, maybe I sell that one, maybe balance a little bit. School, so you have a plan. How can I still be able to pay the school fees? What's the plan? So what that means is that because it's a worst case, during the good days where you are working, and that means you have to take some things. You have to now do some things intentionally. What we tell us that you plan for the future. You plan ahead of the days that might come. They say life happens. So when things are good, it's the time to plan. So it's the same thing. Like the liquidity ratio, you keep some money one side. If you're earning extra, don't go and buy. Nobody's saying don't buy good things. Buy good things, but life can happen. So buy some things. Buy a land here. Buy some shares here. Buy bond. So that if anything, you have something you can sell. That's your own liquidity ratio. You also do your stress test and all of that. But just remember, liquidity risk is the silent killer. I think we've also talked about this one, LCR, NSFR, as we wind down, NOP. That's another limit, 20% of shareholders' funds, regulatory limit. Loan to deposit ratio is not a limit, but it's a threshold, minimum 50%. Just to tell you that they really want you to push out loans. We've also talked about this one. I'm sure you are used to it. HTM, amortized cost, you hold till maturity, no mark to market, you keep there. Of course, there are some exceptions, but if you have to do anything, if they meet those requirements, there's a tinting rule, so you need to take the losses. But generally, you hold to maturity. Hold for trading, you can trade with it, buy, sell, buy, sell, buy, sell. The losses or gain go through P&L. Fair value through OCI, FVOCI, you do mark to market frequently too. Some people do it monthly, but you pass it through other comprehensive income. Yeah, which also goes into your capital. But the HFT is for trading. Someone might ask, so why will you buy something HTM and hold it for 5 years, 6 years? Because depositors can come, things can happen. Why are you now holding it to maturity? One simple example could be that, remember we said you have a regulatory liquidity ratio. So you need to keep 30% in securities and cash. Cash is zero. So why would you want to keep money at zero when you can earn, for example, 18, 20% per annum under this current regime? So because you need to always maintain that ratio anyways, you could as well buy it and just hold. I know that maybe 15, 20% of it, you have it already, while you continue to run your business. Operation and compliance risk. Yes, there are 4 things. When you talk about operational risk, it's coming out as potentially one of the greatest risks that we are now seeing in the banking industry. So when you hear operational risk, you are looking at 4 things essentially that can happen. Internal processes. There's something wrong with your internal processes. Your people, you might be talking internal fraud, external fraud. Systems, the risk that there might be technology or cyber risk, or external events, flooding, war, so many things could disrupt you. Legal issues. So there are 4 of them when you are defining operational risk. Loss from inadequate or failed internal processes, 1. People, 2. System, 3. Or external events. So like credit or market, credit, you are the one that went to look for the customer yourself. Market is macros, it's affecting you. Operational risk can come from inside the building. Again, it's your people. Your people can cause problem. And we've seen cyber risk has been a major issue. It's one of the things that gives us headache. Well, I think from information, we have about 4,700 weekly incidents for banks. Weekly incidents for banks. And I think Nigeria is rated number 5 for impact. So, and you could see legal there. Legal too, is a major issue. People could Google and read up about Fidelity versus SageCom, just to know how legal, so you'll be talking 10 of billions of naira, so if you're a very small bank, that could affect you. So legal is actually true. Like I said, people can read of Fidelity Bank versus SageCom. Compliance risk, I think not much here. We used to be on the gray list. It's like in the bank too. We have customers that are on our gray list. What that means is once you see that customer, if he says he wants loan like this, you run. So Nigeria was on the gray list before. So when you go outside and want to do some transaction with some bank, they'll look at you one kind eye. This guy, this straightforward, he's on the real list too. But we're out of it. Last year, I think one of the major things that this administration also did, which has also helped banks, particularly with correspondent banks, and the profile of Nigerian banks have improved significantly based on this. From a strategic risk level, yeah, we all look liquidity and all that, yes, but there are risks coming up that we are looking at now. AI risk, because we started deploying AI. What are the potential risks? These are risks that are still not very clear to people, but there are risks that are clear, and this is what the banks are now trying to make sure that they also strengthen the skill sets of their respective team. So it's not yet in the textbook. You won't see in a lot of places, but the risk is clear. Climate risk, open banking. You see CBDCs there, like I said, I write it in full. Central bank digital currency. So you talked about Bitcoin and other things. First bank tried to launch something in Naira. It didn't really take hold, but these are things that are now coming up, digital coins, digital currencies, AI, and they will bring their own risks. So these are emerging that we are tracking. Climate risk now is also an issue with what is going on. and this also will affect banks. So all you CROs of tomorrow, you need data analytics fluency. You need to love data. You need to be analytical. Regulatory acumen, you need to be up to date with your regulatory guidelines, what the limits are, what is allowed, what is not allowed. 3, you have to deepen and develop your communication skills because you'll be presenting, talking to senior people, executive management, the board. Even at the junior level, you'll be talking to the businesses themselves who went to bring the risk. So you have to be able to communicate properly with them. This is the risk you are seeing, and these are the mitigants. The CRO of tomorrow, he said, is no longer the person who says no to a strategic partner. So before, years ago, you know, say, hey, we can't do. So that's why they say risk management, everything is no. But you know, risk management have moved from that. Risk management now is a strategic partner. What that means, the risk is there. You quantify the risk. Can you absorb the risk? And can we explore opportunities there? So you provide the broad range end to end, and then you try and deliver. So CRO must have strategic vision, good leadership, and the emerging risks must always be on your radar. Key takeaways. Risk will always be there. The goal is not zero risk. It is the right risk and at the right price. Context is everything. Almost everything for a bank will come from the macros because that's the realities. It will flow into your decision, your risk acceptance criteria, and now your stress and scenario analysis. NPLs are a warning you really need to avoid. Culture beats systems. You might have all the models in place and you can run your number, but what really counts is the risk culture in the organization. Because what that means is that even the person that is going to bring the risk, the business, understands risk, has a risk culture, and that would help. Risk beats system. Let's always keep emerging risk on the horizon. Banking is risk management. Everything else is in the details. Thank you once again for this opportunity. Pleasant morning.
Great one. Thank you, sir.
Thank you so much, Mr. Lutoye.
Thank you very much.
Thank you. I'll share the slide so that, I'll slide the slide. Thank you. Anybody wants to ask 1 or 2 questions? No ask now, fan, please.
So maybe we can go into
always reach me through Prof. I think
Yes,
Akim is also on the call.
Thank you very much, sir.
Akim Razak is a great guy.
So the floor is open to questions.
Yes, we can take questions maybe for another 10 minutes or 5 to 10 minutes. Uzamaka.
Good morning. Thank you very much for this discussion. Well, I think towards the end of the discussion, you mentioned things about CBDC coming up. So I was privileged to meet with one of the policymakers for CBN. I understand the coin is coming back in Nigeria, although still in the still at the policy stage. I want to ask, because now they are going to bring it through the banks. When it comes to risk management, is the bank already working on how to mitigate the risk? Because it's not going to be it's going to be a retail action this time, as against the corporate action where it was CBN that initiated the first one and took charge of it. But this time they'll be coming in through the bank, according to the policy. Is the bank already working on how to mitigate risk around that? Or is the bank still waiting for CBN to give the first public memo before they start doing something around it?
Beside the wardrobe, where those bags are.
If you have started, that's why I mentioned the emerging risk that needs to be on the CRO's level. So for example, for me, my team, I think they're going on a training during summer. So, but you can be rest assured that it's something that is in all the banks' avenue. The bank CRO forum has also noted, yes, you are correct. It's coming back, and we ourselves we are building the necessary skills to be able to dimension the risk. But it's a clear risk, and it's something that is globally. So at some point, it's going to happen. I'm sure some of you guys here, if they say give me account, say transfer to my Bitcoin, transfer to this stable coin. So people are using it. So we just need to also brace up.
Okay, and then a second question. Please, sorry. The next question is this. I know when it comes to Bitcoin, interest is earned on coins that is owned. However, there's a debate now about the coin we're bringing in. Are we going to have interest on them, or are we pushing against interest? I know USA is pushing against interest on their own coin, but then Nigeria, since I believe we have people that are already into Bitcoin, I might not want to switch from Bitcoin to the Naira coin because there is no interest. Is there any talk around interest coming up on our coin?
It's not finalized. Like I said, early discussion with the CBN and the external, so we don't go and give a lot of information. It's not clear. Amaka, are you trading in this CBC? Don't use my comment to go and hedge your position. So, but then I'm sure before the end of the year, we will have clarity. Let me not preempt. Like you said, the argument is both sides, whether there will be interest or not. Bitcoin there are some other stable coins that don't have. So, but let's wait for the final paper or decision. But yes, you are correct. It's part of the main issues being discussed.
Okay, thank you.
Yes, ma'am. Okay, Ayo. Did I get it? Okay. I don't know Israel. I don't know the other. Israel Eden.
Okay. Thank you very much, sir. The training was very insightful. So my question is around the three line of defense, and particularly the first line, which is the business unit. So since they're the owner of the risk, what I've noticed is that most times the business people change jobs like immediately. So a whole lot of them, when they bring in this risk, they are not really interested on how well the business performs. They just want to sell and get commission. Is there a way they can be held accountable, or are there policies that you feel that a company can put in place so that the business unit would be aware and they will be accountable for the businesses they are bringing in, so that it will not just fall on the second line of defense?
Okay, let me answer your question like this. If you check what we said, the risk and compliance, they set the rules. So they set the rules, which means they are the ones that will set the risk acceptance criteria. And in almost all cases, the risk will sign with the business. So it's not as if the business will bring the person to take the loan and it's the business person that signs off. So the risk must sign off and set the rules. That's one. So if there is no case of fraud, you cannot necessarily hold the first line, because also the second line approved and set the rules, which is why the risk manager is a specialist. The business is really about money. So he's not a risk man. He might not understand the model, or this, he won't understand it. His own is, okay, I just have this customer, this. I bring it in. Practically, he will write a credit. They call it, people call it CAM. Yes, CAM. Yes. So he pulls the CAM together. But yes, yeah. But he needs to present the CAM to the second line of defense, largely, which is risk. So it's not as if he's held entirely liable when there's no cases of fraud. Depending on the amount, it goes through what we call MCC. So the Management Credit Committee. So, depending on volumes, you have the Management Credit Committee, depending on volume, it also goes to the board credit committee. So there are some volume that management credit committee cannot sign alone. The board credit committee must sign. In actual fact, while we're on this fact, all insider credit, no matter the amount, must go to the board. Standard banking rule. All insider credit, no matter the amount. But for all other credits, you have specific amounts. So even the basic one might be the chief credit officer and the business. You get. So they are like, the risk manager approves. So if MCC approves something, will you hold the business against it? Except there are cases of collusion. When we talk about operational risk, there was when you see the slide, there was something about internal fraud. So sometimes, a lot of the business we see it almost every time, particularly for the retail end, SMEs. People can go outside and package things. You get, start company, put their wife there. You get what I mean? We know these things now. You know the works. Nigerians are very brilliant people. So people package a lot of things. Or maybe you package a loan, then you japa to another place. So if there are cases of abuse, yes, but on a BAU basis, you really can't. And there is there's also the what do we call it now? You cannot just hold someone that wants to resign, for example, except you have strong cases. Even if there's a case of fraud, there's also a process. The person can resign. You can pursue a criminal case with the person. You understand? But you can now, people also have their liberty. Just like the Obi Kubana people are doing City Boy. And people are saying, why are they joining? But their liberty are
Yes. Okay. Thank you very much, sir. But another part of the question is, how about if a credit risk team reports to the business team? And most of the decisions, to a very large extent, even though sometimes they consult the credit team or listen to them a few times, in a situation where the credit team is headed or reports to the business team, how would one in that particular team react as in to things? Because most especially the business team would always want to sell. Since you report to them, they have targets. And the credit team was employed by, say, the business team, the CEO of that particular team, and is a business person.
Yes, the credit team will not report to the business.
I want to say something here, if allowed. I want to say the credit team has the right to analyze this business or this customer that you are bringing in. So if they told you that is a risk, or you are the owner of they told that is a high risk, and you are the owner of the business, and you are still not listening, then it doesn't have anything to do with them, and the business team is only doing their job. I don't know.
No, that's not what I'm saying. That's not what I'm saying. Well, what I'm saying is this.
I understand. Let's just know that even though the business is bringing the risk, the risk will sign off. So they are now together. So you can't separate it. So back to your question, the credit team will report to the chief credit officer, and in almost all cases will report to the chief risk officer. So there's a risk line. Remember what we said about the second line of defense in the world, incident. So it's a risk profile. What happens like in my own cases, in my own bank, for example, that the business themselves, because they too don't want problem, the business themselves can have what they call risk specialists in their team that reports to the business, but they will advise their directorate, maybe there's every director, on what these guys are doing. But you will still need the concurrence of the independent team, which is risk. And the risk organogram is independent all the way to the board risk and board credit.
Okay, thank you very much.
That is clear. So when I say they own the risk, it's just because they are the one that go out and market. You get, so, but no, they can't bring anything in like that. You get, because for example, before they go out, you already set the rules for them. You understand? And when they bring it anyway, you will have to run the analysis and you will have to sign off. So it's now joined this thing.
Okay, so that makes a lot of sense. So my question is, in a proper organization, just like what you've said, this is how the process is. But in an organization, say a microfinance bank that doesn't have this kind of structure, The structure now is the credit risk team, to a very large extent, reports to the business head, let's say the CEO or the director of merchant lending. So the business team, the credit analyst has said that for this kind of customer, the DTI shouldn't be more than 35 because that's the policy on ground. And the tenor shouldn't be more than 6 months because of what we've seen. Then they pushed it to the CEO. Since the credit team report to the CEO and the CEO is like, okay, we can just adjust it. You can override it. So that's just the issue. That's what I'm
If anytime the risk team reports to, if it happens, if it reports to the business team, of course, you know that independence is gone now, right?
That's what
so that's the flip side. But you know, for a small business owned by the, this thing now, we're not talking about banks that are well structured and all that. You get, even you yourself, if you set up your own business, one man will just say, maybe it's my business. You get, which are you saying? Is it your money? So maybe a one-man business then can now start running. But even when you work in a one-man, we all know that it's not the best place for, you get what I'm saying? For best practice. But anytime the risk team reports to the business, you know that independence cannot be totally guaranteed.
Exactly. Okay. Thank you, sir.
Yes, boss. John, I thought we were just taking 10 minutes.
Okay.
John.
Okay, thank you, sir, for the holistic
I don't know about holistic, but thank you.
I'm happy for this section. However, my question is just a kind of rundown on how we can use derivative instruments to hedge credit risk. If you can just throw more light on that, I'll really appreciate it. Thank you.
That's a full session in itself. But let's do an example. You expect that FX rate will go up. You expect that the FX rate will go up, but the Naira will devalue. You can try and take maybe an FX forward and try and hedge the risk. What that means is that you buy it today, you buy at a particular price and the volume, and you lock it in. And irrespective of the price on that particular day, so maybe you buy 6 months forward, you buy it for delivery September ending. You buy today at 1,450, but you are so convinced from your analysis and your model that the rate will go up. So you lock in today, 1,450. The counterparty will deliver in 6 months, September ending. September ending, the counterparty will deliver your, let's say, $1 million, but the rate is at 1.6. That means you got it right. But the counterparty will deliver to you at 1,450 because you have agreed that rate before. So you have hedged your FX risk using the FX forward. But what the forward does, you are talking about exchange rate risk here. So every time you also have to remember there is a counterpart risk forward. On that September, are you dealing with a reliable counterparty that will not default? So that other risk is there. But FX risk-wise, yes, you've locked in, and that's just one of it. But just to give you an example, so you have an idea, that's the total session. You have various, you can use FX swap, you can use interest rate risk swap. So there are so many things we can do on that. We can work on arranging a session on derivative with Prof.
Thank you, sir. I really appreciate it.
I want to quickly say something. Let's start by appreciating you, sir, for the session we've had. It was very insightful. But I want to say that prior to now, in the insurance industry, we had the recapitalization in which the insurance companies were tiered. And it got to a level where we found out that the brokers, who are the main people that feed insurance companies with businesses, it was said discriminated against those in the third tier and stuff. Now, if the banks have now gone into tiers 2, maybe the next 2 days or thereabouts, are there no likelihood that both corporate, customers and retail customers will start discriminating against those banks who are at the regional level? I mean, the decision of CBN to tier the banks, if it work against, for instance, the regional banks, as it did, prior to now that we are also recapitalizing again the insurance industry. That first time, the one before this, it was actually working against those in the lower tiers. Wouldn't it affect the bank that thing this time around? That's my question.
Okay, let me reverse the answer like this. the categorization by CBN is really based on where you can do your business. So the categorization is based on where you can do your business. So CBN, they are classified as one, regional bank. What that means is that you can only do your banking in a region, Southwest region, Northwest. So it's a region. So because you are not national, your capital base is reduced, 50 billion. The next one is national bank. You can do your business in Nigeria. Your capital base is 200 billion. The other one is international bank. So you can do your business globally. So you see example of, is it Zenith Bank or Access that is going to open another branch in UK? So you see those banks opening branches internationally. That's international bank. So the capital base is strictly based on that categorization, not on strength. But of course, what people do is, just general investors, or those, like Augusto, all those. What did I try to do is to look at balance sheet size and other things and put some banks as tier one, Fugas and all that. But from CBN, the category is regional, national, and international. And of course, the international banks are now naturally classified as systemically important banks because they are large, they are big, their capital base is big. So if anything happens to them, it might shake the industry a little bit. But the banks themselves they are okay. Except, so I don't really foresee, and we've been running this regional national now for years. But the tiering is not. But I get what you're saying. Maybe if a bank was, tier 3, I guess, well, if you are an investor that wants to put in some big money, you might consider other banks. And if you read a lot of reports, if they are telling you which stock to buy and hereby, they'll tell you buy the, the big boys and all that. Yeah, so it can be a natural selection issue. But the banks and the tier 3, tier 2, tier 1, they are all doing well. But the tiering like that is just investors. The real tiering by CBN is regional, national, and international. But you made a fair point. Maybe, in life, if you are further down the radar, things are more difficult. It's as simple as that.
So, thank you, sir.
Yes, so my CRO, sir.
Yes, boss.
We continue, this student will not allow you to go. So
Thank you.
We are highly enriched on your discussion on risk management in Nigeria banking, from concepts to realities of the operating environment. As you all know, silver and gold, we do not have, but we have our special plaque, which we will personally bring to your office as a department to come and show our appreciation. So I hope if we call on you some other time, you will gladly oblige us.
That's fine. That's fine.
To do the vote of thanks, I have...
just a final comment from me too.
Yeah, so my senior colleague is here, Professor Balola. Professor Balola will do the vote of thanks, and then you can have your final comments.
Okay.
Professor Balola, over to you, sir.
Thank you, my HOD, for the honor to give this vote of thanks. However, let me just ask this with your kind permission. Let me ask our lecturer, our presenter of today's seminar. So I read through your profile, sir, and I saw that you have one way or the other helped to shape the risk culture at Sterling Bank. Were there instances where you had to go into conflict with the management, particularly the CEO, about the direction you think the bank should go, and then they did not see it that way? How are you able, if there were, how are you able to manage such instances?
Thank you, Prof. Two things that will leverage on communication. I talked about it when we were talking about effective CRO. Communication skill is very important. And also I talk about analytics. So, when you talk about some credits, people look at it from two different lenses. The MD will be looking at it and wondering, I need to do this business, but you are looking at the models. If you're able to communicate it effectively, which is what I was able to do in some instances, and you're able to back it up with realistic and reasonable data, and in almost all cases, the CEO will relax. So yeah, then we might have one or two outliers. You also, like we say, you're a strategic partner. So when it's always a strategic partner, so you also rise above the numbers a little bit, and you're not trying to see the strategy behind it. So the MD can come and say, look, I've seen the numbers, but this is what I'm thinking. I need to be able to, I want to break into this industry or into this sector. I want to leverage this customer to be able to break in. Based on what you've said, if you can still let us break in, but we'll put this additional mitigant to balance it and moderate the risk. So because we are a strategic partner, I know we talked about risk and opportunity. You can ask about, you looked at the numbers and said, look, okay, this is the long-term gain. There's always a long-term gain. So when you look at the long-term gain, you can now balance it as, okay, but let's introduce this mitigant. So once you get to that level as a CRO, it becomes much easier. One, you've communicated effectively. Two, they can see clearly the numbers. I know that there's an issue here. We see one recently that we said, there's an issue here. He now had to say, and I explain and say, look, it's clear. But these are the concerns we have. Okay, we'll push for additional collateral. But you have to remember, a CRO is also a strategic partner. So you have to also be able to see the long game. There's always a long game, which is where the vision is, the strategic vision. You must also be able to see it while moderating the risk. It's like maybe a family man. He has his wife, he has his children. Too many things are happening now, can be happening around him. But the man, he still has to have that vision. So you might take some things now that might look somehow, but he's really seeing where he's going. Nobody else will be able to see it. So if the MD is seeing something, you also will be able to. If you can't see it's a different thing, then you stamp your foot down. But you're a strategic partner, you also have to be able to see the long game. And that long game will make it easier for both of you to be able to arrive at a reasonable solution.
Thank you very much for that insightful response. And I hope our students, our participants, they have achieved a lot. But let me start this vote of thanks by first thanking God Almighty, the Lord of incomparable majesty, the one who only permits. It is with his permission that today's seminar was able to take place. But it's always said that man proposes, but God disposes. First, we give thanks to Almighty God for making today a reality. Therefore, planning that we're going to have the seminar today and for making it possible. So we give thanks to God Almighty. Then we want to turn to our facilitator, our presenter, Mr. Olutoye, the Chief Risk Officer of Sterling Bank. And of course, it's not just the Sterling Bank that you were starting your career. You held several positions in other industry apart from the banking industry. We want to thank you. We want to appreciate you for finding time out of your very busy schedule. People at your level, you are on top management level, for you to have spared the time to share your knowledge, your wealth of wisdom and knowledge with us. We really appreciate that. You see, I'm sure some of our students will start appreciating why we introduced this seminar. We don't just want it to be theoretical. We want people from the industry to come also share their practical experience. And I'm sure they can relate some of the things we have taught them in class with what you have you've been able to share with us today. So we give thanks to you. We appreciate you. And we pray that God Almighty will continue to uplift you. Will continue to make you a shining star in the industry. And we hope that anytime that we call you again, because we like to play Oliver Twist, you also want to yield to our call. We thank you very much. We pray that God Almighty will continue to be with you and your entire family. Thank you very much, sir.
Thank you, Prof. Thank you, Prof. So I think also just from my end, just to thank the department, Actuarial Science and Insurance Postgraduates. So thank you all for joining this seminar. I hope you'll be able to learn one or two things. And I'm always available if you need me. I think too, to also show appreciation to the professor for the program. And like you mentioned, for actually introducing this series, because most times the reality out there, you're able to tie it in with the textbook, and also that you are able to also balance strategy, the vision, and the risk management. So it's important that you have real life scenarios from people out there who face the heat and what they look at, apart from just strictly the numbers. So I just want to say that God will be all of you. I wish you success in all your endeavors. And I also pray that the department will continue to grow in leaps and bounds. Have a lovely weekend and a lovely year ahead. And thank once again for the opportunity.
Thank you, sir. Thank you, sir.
Thank you
very much.
Thank you.
Sir.
Thank you.
Thanks a lot, sir.
It's a pity that it's not a
For this
physical
insightful
facilitation. We'll have given
seminar.
you a very locomotive clap, but I'm sure we can also you can see that it's already coming up even virtually.
You have great and brilliant students.
Thank
The
you very
question
much.
they are asking, it tells me you've gone far.
Thank you very
People are
much.
even talking Bitcoin.
Thank you very much.
Thank you. God bless us.
And thank you for also recognizing one of our own, Hakeem.
Yes, Hakeem is on the call. Hakeem is a great guy.
At the program.
Yeah, he's a great guy. There's nothing to add. He's a great guy.
That's what gladdens our heart when we see our product doing very well outside.
He's exceptionally well. We used to work together too.
Oh, that's
I don't know that I mentioned it. We used to work together.
Yes, he did. He did.
Yes. So we are very close. So it's not very, very close. We speak almost every other day. That's how close it is.
So, sir, we'll pay you a visit in your office.
That's fine.
To personally present our plaque, sir.
Just let me know the dates out there. We'll agree the dates, yes.
Yes. Thank you very much.
Thank you.
So thank you, everyone. Okay. On this note, we'll bring today's curtain closed. And
thank you so much.
Bye-bye.
Thank you, sir.
Thank you very much. Thank you.